We are now entering the final countdown. Please look closely at the date on your screen. It is Wednesday, December 31st, 2025. We are exactly 36 hours away from the moment the global financial architecture changes forever. In 36 hours, the sun will rise on January 2nd, 2026. The holiday celebrations will be over, and the China silver export ban will become active law. But we do not have to wait for Friday to see the damage. The destruction of the old system is already here. For the last 48 hours, we have been warning about a bifurcation, a violent splitting of the silver market. Today, that split became a fracture, and that fracture just became a chasm. As I speak to you right now, there is no longer a single price for silver. The global market has shattered into three distinct realities. If you are looking at the price on your standard banking app or a financial news terminal, you are looking at the wrong reality. You are looking at a ghost. You are looking at a price that has no basis in physical truth. This afternoon, a three-tier market has emerged that defies every law of modern economics. Tier 1 is the panic price. This is the reality in Shanghai. The Shanghai Futures Exchange closed its final session of the year at an equivalent of $84.55 per ounce. This is the price being paid by the manufacturing capital of the world. This is the price being paid by the industrial entities that actually consume the metal to produce solar panels and electronics. They are desperate. They are front-running the export ban, and they are paying whatever it takes to secure inventory before the doors lock in 36 hours. Tier 2 is the physical price. This is the price found in the Middle East, specifically in the physical markets of Dubai and the United Arab Emirates. We have confirmed live transaction prices averaging $79.61. This is the honest physical market. It is not in a total state of panic like China, but it is extremely tight. It is demanding a massive premium. This market is telling us that even outside of the Chinese export ban zone, physical silver is trading nearly $8 higher than the paper spot price in the West. And then we have Tier 3. This is the zombie price. This is the COMEX spot price in New York. It is currently trading at $72.15. Do the math with me. $84.55 in Shanghai versus $72.15 in New York. That is a spread of $12.40. That is a 17.2% premium. In a functioning global economy, a spread of 17% on a fungible commodity like silver is impossible. Arbitrage traders, the big banks, and the hedge funds exist specifically to close that gap. If they could, they would buy every single ounce in New York at $72 and sell it in Shanghai at $84. They would make risk-free billions of dollars in a single afternoon, but they are not doing it. The gap is not closing. In fact, it widened from $5 yesterday to over $12 today. The bridge has been burned. New York is now an island of paper trading, stranded in a sea of physical shortage. Why is the arbitrage dead? In a normal world, money flows to where the profit is highest. If silver is $12 cheaper in New York than it is in Shanghai, the global banking system should be moving thousands of tons across the ocean right now to capture that gain. But they are standing still. They are paralyzed. The traders know that the January 2nd deadline is a hard wall that cannot be climbed. They know that if they buy silver in New York today, they cannot physically ship it, clear international customs, and land it in a Chinese warehouse before the new export licenses go active in 36 hours. The logistical window has slammed shut. This brings us to the terrifying reality of the three-tier market. To understand where the price is going, you must understand which tier you belong to. Tier 1, the Shanghai price of $84.55, represents the future. It is the lead indicator. China is the largest consumer of silver for industrial applications, specifically for the massive solar energy transition. When the world factory is willing to pay $12 over the Western spot price, it is telling you that they value the physical atom more than the paper contract. They are not trading for profit. They are trading for survival. Tier 2, the Dubai price of $79.61, represents the global baseline. Dubai is often called the city of gold and silver for a reason. It is a neutral hub where physical metal actually changes hands. The fact that Dubai is trading nearly $8 above New York proves that the shortage is not just a Chinese problem. It is a global physical deficit. The Middle Eastern markets are stripped of supply. Investors are pulling metal out of the banking system and moving it into private vaults. They no longer trust the counterparty risk of the Western financial institutions. Then we must look deeper at Tier 3, the zombie price of $72.15 in New York. This price is a lie. It is the price of a paper contract that fewer and fewer people want to hold. For decades, the COMEX has been the global price setter. It used high-frequency algorithms and massive leverage to suppress the price of silver. But the COMEX has lost control. It is no longer the price setter. It has become the price suppressor. And the physical world has finally decided to ignore it completely. The fact that the paper market is lagging by $12 tells you that the system is broken at a fundamental level. We are seeing a complete decoupling of price from value. In New York, silver is a digital digit on a screen. In Shanghai and Dubai, silver is a strategic industrial metal. When these two realities collide, the digital digit always loses. The $12 spread is not a temporary anomaly. It is a signal of the end of the paper-silver era. The market is telling us that the ability to deliver physical metal is the only thing that matters now. If you are holding paper silver in an account that does not allow for physical withdrawal, you are holding Tier 3. You are holding a zombie asset. You are betting on a price that the rest of the world has already rejected. As we move closer to the 36-hour mark, the gap between the zombie price and the real-world price will only grow wider until the COMEX is forced to either settle in cash or declare a total default. While the price spread is the most visible symptom of a dying system, the volume of physical delivery requests is the actual cause of death. We just received the delivery data for the final session of 2025, and it confirms our worst fears. Yesterday, we saw a vacuum operation in China. Today, we are seeing a full-scale run on the bank in New York. The delivery volume has not just increased. It has gone vertical. We are talking about a 26 times increase in physical demands in a single 24-hour period. Let us look at the numbers that are draining the COMEX vaults dry. Do you remember our last update? We pointed out that out of billions of paper ounces traded on the exchange, only 69 contracts stood for physical delivery. That represented a paltry 345,000 ounces of silver. It was a joke. It was evidence that the New York market was almost entirely speculative, with no intention of moving real metal. But today, the joke has ended. We have just received the preliminary delivery notices for the December 31st session. The number of contracts standing for physical delivery has exploded to 1,847. Let us do the math on that. 1,847 contracts multiplied by 5,000 ounces per contract equals 9,235,000 ounces. 9.2 million ounces demanded in a single day. Compare that to yesterday. 345,000 versus 9,200,000. That is a 26 times increase in physical demand in just 24 hours. This is not a standard pickup in volume. This is a raid. This is a panic event. It means that nearly 2,000 large entities, including banks, hedge funds, and industrial giants, looked at the calendar, saw January 2nd approaching, and hit the deliver button simultaneously. They are no longer content to roll their contracts forward into the next month. They are no longer content to hold paper exposure or digital promises. They want the bars. They want the silver in their own possession. They are effectively cashing out their chips before the casino closes for the night. They know what happens in 36 hours. They know that once the China export ban goes live, the global supply chain freezes instantly. They understand that the $12 premium in Shanghai is going to act like a financial black hole, sucking up every available ounce of silver on the planet. So they are raiding the COMEX vaults while the price is still suppressed at $72. Think about the arbitrage from their perspective. They can use their paper contracts to demand delivery at $72.15. If they can get that metal out of the vault, they instantly own an asset that is trading at $84.55 in the real world. They are buying dollars for 85 cents. It is the trade of a lifetime. But it only works if you can get the metal right now. This 26-fold spike in delivery demands is the system trying to correct itself violently. It is the sound of the paper shorts getting trampled by reality. Imagine being a bullion bank that sold those 1,847 contracts. You thought the buyer would just roll the contract next month like they always do. And suddenly today, they demand the metal. You have to find 9.2 million ounces of physical silver today. Where are you going to get it? Shanghai is closed to you. The premiums in Dubai are nearly $8 over spot. You are trapped in a liquidity death spiral. This massive delivery spike is the exact mechanism that breaks the banking system. When you force a paper market to deliver physical assets at 26 times the normal rate, you drain the liquidity of the entire system instantly. This explains exactly why the banking system is screaming for cash right now. It explains why the Federal Reserve had to intervene again today, December 31st, 2025. The banks are not just losing money on the price spread. They are bleeding cash, trying to settle these massive physical deliveries. If yesterday's $3 billion injection was a warning shot, today's injection is a confirmational signal that the bleeding has not stopped. In fact, it is getting much worse. We have uncovered another massive liquidity operation that happened quietly while the world was watching the New Year's Eve countdown. Let us look at the $5.8 billion secret bailout that is keeping the system afloat at this very moment. When we look at the Federal Reserve balance sheet this afternoon, the data is terrifying. You might have assumed that the $3 billion injection yesterday was a one-time event, a singular band-aid for a singular problem. But the data from this morning proves that the wound is not healing. It is hemorrhaging. We have just confirmed that the Fed executed a second emergency repo operation today. The amount was $2.8 billion. When you add that to yesterday's $3 billion, we are looking at a total of $5.8 billion of emergency liquidity injected into the banking plumbing in just 48 hours. To put that into perspective, $5.8 billion is more than the entire market capitalization of most mid-tier mining companies. It is enough cash to buy nearly 80 million ounces of silver at current prices, and the banks burn through it in only 2 days just to stay solvent. Why do the banks need nearly $6 billion of overnight cash right now? It is because of the delivery spike we just discussed. You must understand the mechanics of a short squeeze on the bullion banks. When those 1,847 contracts stood for delivery today, the banks on the other side of the trade, likely JP Morgan, Citibank, and Bank of America, were caught in a liquidity trap. They are short paper, but they owe physical. To fulfill those deliveries, they have two choices. Choice A, they deliver the metal they have in their own vaults, but their vault levels are running low, and they are terrified of emptying them completely before the China ban starts on January 2nd. Choice B, they have to go into the open market and buy the metal immediately to hand it over to the client. But the open market is broken. If they try to buy silver in Shanghai, they have to pay $84. If they try to buy it in the UAE, they have to pay $79. But they sold the paper contract at $72. They are locking in a massive loss on every single ounce they deliver. They are buying high and delivering low. This destroys their cash reserves and burns a hole in their balance sheet instantly. They run to the Fed's repo window to borrow the cash to cover the spread and to finance the settlement. The $5.8 billion is effectively the cost of the spread. It is the price the Western banking system is paying to keep the game going for another 24 hours. The building is on fire, and they are using a money hose to spray down the flames so the public does not see the smoke. While the banks in New York are desperately trying to plug the holes in their balance sheets with paper dollars, the vaults in Shanghai are being emptied of physical reality at a speed that defies historical precedent. We talked about the 41 tons that vanished yesterday, and many of you thought that was a one-off event, a singular strategic move. But the data from the Shanghai Gold Exchange clearing report this morning proves that it was not a one-off. It was just the first wave. We have now confirmed that an additional 43 tons of silver were withdrawn during the December 31st session. When you add that to yesterday's 41 tons, we are looking at a total of 84 metric tons of silver removed from the exchange in just 48 hours. Let us translate that into ounces because the sheer weight of this move is hard to comprehend. 84 tons is roughly 2,700,000 troy ounces gone. It has been removed from the registered stockpile, loaded onto armored convoys, and driven into the dark. To put this burn rate into perspective, the Shanghai Exchange typically sees withdrawals of maybe 2 or 3 tons a day during normal trading. We are currently seeing withdrawals of 42 tons per day. That is a 1,400% increase in physical offtake. This is not normal industrial consumption. Factories do not suddenly need 14 times more metal overnight to build solar panels. This is panic hoarding. This is the smart money in China looking at the clock, seeing 36 hours left until the January 2nd export ban, and deciding to drain the swamp completely. The impact on the total inventory is catastrophic. We have been tracking the Shanghai inventory levels for years. 2 days ago, we were worried because the level had dropped to 755 tons. Today, the official inventory count has crashed to 727 tons. Think about the math of that trajectory. They are draining roughly 3.5% of the entire exchange's inventory every single day. If this rate continues, the Shanghai Gold Exchange will be mathematically empty in less than a month. But it will not take a month because markets do not go to zero in a straight line. They snap. When the inventory drops below a certain psychological threshold, usually around 500 tons, the panic accelerates. The buyers realize that there is not enough for everyone, so they double their orders. We are watching the beginning of that exponential curve right now. You have to ask yourself, who is taking this metal? It is not the retail guy buying a few coins. You do not withdraw 84 tons in coin form. This is the state. This is the strategic reserve. These are the battery conglomerates like CATL and BYD. These are entities that have inside information. They know exactly how strict the new export licenses are going to be on Friday. By withdrawing 84 tons in 2 days, they are telling us that they expect the global supply chain to freeze completely. They are engaging in preemptive logistical capture. They are securing the atoms before the politicians secure the borders. This creates a terrifying feedback loop for the West. Every ounce that leaves the Shanghai vault is an ounce that can never be moved back to London or New York. It is an ounce that is permanently removed from the global float. This hoarding is not just happening in the dark corridors of the Shanghai Gold Exchange or the confidential ledgers of the Federal Reserve. The panic has trickled down from the geopolitical level to the corporate boardroom. It has infected the real economy. We must talk about the industrial giants because they are the ones who actually drive global silver demand. For the last 20 years, the entire global manufacturing system has run on a philosophy called just-in-time. It is a beautiful system when it works. You do not hold large amounts of inventory. You do not pay for massive storage facilities. You order exactly what you need for this week of production, and the truck arrives at the loading dock exactly when the assembly line needs it. It is efficient and it maximizes cash flow. But just-in-time has a fatal flaw. It relies on the absolute assumption that you can always get what you need, at the price you expect, whenever you pick up the phone. Today, that assumption is dead. Today, the biggest companies in the world realize that just-in-time is about to become not in time. If they do not secure the metal now, their factories will go dark in February. We have received credible reports from inside the Asian supply chain regarding Samsung. Samsung is not just a consumer electronics company. They are one of the largest consumers of silver for high-tech batteries and circuit boards in the world. According to supply chain sources, Samsung has just executed emergency procurement orders to secure 6 months of silver supply in advance. Think about the magnitude of that shift. Usually, a company like Samsung holds maybe 2 weeks of inventory. Overnight, they have decided to hold 26 weeks. They are effectively taking half a year of demand off the market today. Why? Because they see the same data we see. They see the 84-ton drain in Shanghai. They see the export ban coming on Friday. They know that without silver, they cannot make a single circuit board or a single high-capacity battery. For Samsung, paying a $5 premium or even a $10 premium is irrelevant. The cost of silver is a small fraction of the total cost of a smartphone or an electric vehicle. But the cost of zero silver is total bankruptcy. And they are not alone. We have seen internal memos circulating from Tesla's procurement division, specifically related to their solar roof and electric vehicle battery segments, labeling their current silver inventory levels as critical. The memo reportedly authorizes purchasing managers to pay significantly above the spot price to secure immediate physical delivery. This is the smoking gun. When Tesla tells its buyers to ignore the spot price and just get the metal, the paper spot price becomes meaningless. Tesla is now bidding against Samsung. Samsung is bidding against Apple. Apple is bidding against the Chinese solar giants like LONGi and Jinko Solar. They are all fighting for the same shrinking pie. We know that China controls 80% of the world's solar panel production. The new TOPCon solar technology uses about 13 milligrams of silver per watt, which is nearly double the amount used in older cells. What do you think the Chinese solar manufacturers are doing right now? 36 hours before their own government locks down the export market, they are vacuuming the domestic supply. They are ensuring that while the rest of the world starves for silver, China will have enough to dominate the global energy transition for the next decade. This is strategic resource capture disguised as a market rally. The disconnect between the paper price and the real world is not just happening in corporate boardrooms. It is happening on Main Street. It is happening at your local coin shop and on the websites of the major online bullion dealers. If you think the price of silver is $72.15 because that is what the ticker says on the news, try to buy an ounce of physical silver for that price. Go ahead and try. You cannot. We are seeing a complete decoupling of the street price from the spot price. Let us look at the premiums right now, because they are the only honest price signals left in the Western market. If you want to buy a United States Silver Eagle, the standard government-issued bullion coin, you are not paying $72. The current premium on Silver Eagles has exploded to over $12 above the spot price. That puts the real price to acquire a single eagle at roughly $84. Does that number sound familiar? It should, because $84 is the exact price silver is trading at on the Shanghai exchange. Do you see the convergence? The paper price in New York says $72, but the real price in Shanghai is $84. And the real price at your local dealer is also $84. The physical market has already repriced silver. The only entity that has not admitted it yet is the COMEX. The physical market, whether it is a factory in Shenzhen or a coin shop in Texas, has unanimously decided that silver is worth $84. The $12 premium is not a simple surcharge. It is the gap between fantasy and reality. Let us look at the Canadian maples. Usually these trade at a $2 or $3 premium. Today they are commanding a $10 premium. Even generic rounds, which are just basic pieces of silver with no collector value, are trading at $8 over spot. In a normal market, generic silver trades for about 90 cents over spot. An $8 premium on generic silver is an 800% increase in the cost of physical acquisition. This is the market screaming at you. The dealers know they cannot replace their inventory at $72. They know that if they sell you a coin today, they might have to pay $80 or more to get it back next week. So they are pricing in the future. They are pricing in the shortage. They are effectively telling you that the spot price is fake. If you want this metal, you must pay the real price. We are also hearing reports that the supply chain behind the dealers is starting to freeze. The major wholesalers, the ones who supply the largest online dealers in the world, are halting sales. They are pulling inventory off their websites. You will see out of stock or alert me buttons appearing everywhere. Even worse, you will see pre-order estimated shipping in 6 weeks. In the silver world, 6 weeks is code for we do not have the metal and we hope we can find it before you sue us. When you see a 6-week delay in a market this volatile, it means the mints are backed up, the refiners are empty, and the system is gridlocked. The billionaire CEO and the small-time stacker are now voting with their wallets, and they have all decided that the paper price is a museum exhibit. We have exposed the $5.8 billion of emergency liquidity used to keep the system from collapsing this week. But now we must stop looking backward and start looking forward. We are staring at the most dangerous 36 hours in the history of the silver market. The clock is ticking down to Friday, January 2nd, 2026. This is the date the China export ban becomes active law. This is the date the global supply chain officially locks down. But markets do not wait for the news. They front-run the news. I am going to walk you through exactly what is going to happen in the next 36 hours. I am going to map out the event horizon so you are not surprised when the chaos begins. We are now entering phase 1, which I call the last train. Right now, we have less than 12 hours before the global markets shut down for the New Year holiday. The Shanghai Futures Exchange closes in a few hours. The COMEX closes this afternoon. This is the final window of liquidity. This is the last chance for the paper shorts to cover their positions before the rules of the game change forever. And this is the last chance for you to secure physical metal before the premiums explode again. If you are watching the screens tonight, do not be surprised if you see one last violent move. The banks might try to smash the price to $70 to trigger sell stops and grab liquidity, or they might capitulate and send it to $75, but the price does not matter. The possession matters. Once the closing bell rings tonight, the doors are locked. The train leaves the station. If you are not on board with physical metal in your possession, you will be left on the platform. Then we enter phase 2, which I call the void. Tomorrow is Thursday, January 1st. The markets are closed, the screens are dark, and the ticker is silent. But do not make the mistake of thinking nothing is happening. Thursday will be the most stressful day in the history of the bullion banking system. While the public celebrates the new year, the risk managers at JP Morgan, Citibank, and Goldman Sachs will be in emergency meetings. They will be looking at the 84-ton hole in the Shanghai vaults. They will be looking at the 1,847 delivery notices they received today. And they will realize that when the sun comes up on Friday, they have to find over 9 million ounces of silver that simply do not exist in their registered accounts. Thursday is the day the industrial panic goes into overdrive behind the scenes. This is when the CEOs of Samsung and Tesla make the urgent phone calls to the private refiners. They will be bidding for metal in the dark, paying secret premiums that would make your head spin just to secure supply before the market reopens. We will not see these prices on a chart on Thursday, but we will feel the impact of them on Friday morning. The silence of the holiday is the calm before the storm. As the sun rises on Friday morning, January 2nd, 2026, the global financial community will confront a term that most retail investors have only seen in the fine print of insurance contracts. That term is force majeure. It is a French expression meaning greater force. In the world of high finance, it is the ultimate kill switch. It is a legal clause that allows a party to a contract to be relieved of their obligations when an unforeseeable and uncontrollable event makes performance impossible. With the China silver export ban now active law, the borders are effectively sealed for industrial silver shipments. This is the definition of a force majeure event. Watch the news terminals carefully during the opening hours of trade on Friday. I believe we will start to see a wave of notices from smaller bullion dealers, refiners, and even some mid-tier industrial suppliers declaring force majeure. This is the moment the masks fall off. When a dealer or an exchange invokes force majeure, they are essentially telling you 3 things. First, they are admitting they do not have the silver you purchased. Second, they are stating that they cannot get the silver from their usual sources because of the Chinese lockdown. And third, They are notifying you that they will not be delivering your physical metal as promised. Instead, they will offer a cash settlement. They will say, "We are sorry, but we will credit your account for $72 per ounce, which was the closing spot price on December 31st. But here is the trap. While they offer to pay you $72 in paper currency, the real-world price of silver in the physical market has already gapped up to $84 or even $90. If you accept the cash settlement, you are being liquidated at a massive loss relative to the replacement cost of the metal. You are being handed a stack of paper that has lost its purchasing power in the silver market. The industrial giants like Samsung and Tesla will not accept cash settlements. You cannot build a circuit board with $72 bills. You need the atoms. This is where the paper market loses all remaining credibility. When a futures exchange or a major dealer defaults on physical delivery and forces a cash settlement, it proves that the paper contract was never backed by the underlying asset. It was just a side bet on a price that the exchange could no longer control. This is the official death of paper silver. The gap between the paper price and the physical price will not just be a spread anymore, it will be a total disconnection. We could see the COMEX screen stuck at $80, while the price to actually buy a silver bar from a private vault hits $120. In this environment, the ticker on your screen becomes a museum exhibit of a failed pricing model. The only people who will have silver on Friday are the ones who ignored the paper promises and took physical possession before the 36-hour countdown ended. This force majeure event is the final transfer of liability from the banks to the paper holders. If you are holding a digital digit, you are holding the bank's failure. If you are holding the metal, you are holding the future. As we stand on the precipice of this new reality, we must understand that what we are witnessing is not just a market rally. It is a fundamental transfer of wealth from the paper shifters to the physical holders. For more than 40 years, the Western financial system has used leverage, derivatives, and high-frequency trading to keep the price of silver artificially low. They created a world where digital promises were treated as equivalent to physical metal. But as the 36-hour countdown expires, the world is rediscovering a hard truth. You cannot print silver, you cannot hack it, and you cannot default on it if it is in your own possession. The era of paper silver ends tonight. The era of strategic silver begins on Friday morning. In this new era, the value of an asset is no longer determined by a ticker on a computer screen in New York. It is determined by its utility in the real economy and its scarcity in the physical world. When companies like Samsung and Tesla are willing to pay any price to secure supply, they are telling you that silver is no longer just a precious metal for jewelry or investment. It is the indispensable oxygen of the modern high-tech world. It is the conductor of the energy transition. My final message to you before we enter the new year is simple. Do not look at the red candles on the paper charts and feel fear. Look at them and feel pity for the people who are trading real, tangible assets for paper currency that is being printed by the billions just to cover up a systemic banking failure. You are on the right side of this trade. You are holding the asset that the most powerful corporations on earth need to survive. You are holding the asset that China is strategically hoarding to ensure its dominance over the next decade. The $5.8 billion bailout from the Federal Reserve is the ultimate proof that the old system is exhausted. They have run out of metal, and now they are running out of time. When the opening bell rings on January 2nd, 2026, the scoreboard is going to change, and it is going to change violently. The $12 premium you see today is just the beginning. In a world of zero exports and total industrial panic, the sky is the limit for physical silver. The warning has been delivered, the timeline is set. I will see you on the other side of the gap. If you found this analysis valuable, make sure to like, subscribe, and share this broadcast with those who need to hear the truth before the clock hits zero. This is John A.G. from Currency Archive. Stay safe, hold fast, and get ready for the repricing of a lifetime. Happy New Year, and prepare for the silver dawn.